My name is Andrew Stotson. I want to welcome you to the Valuation Master Class Show. This is where I share the things that I've learned about valuation and the types of things that we talk about also in the Valuation Master Class Bootcamp. The next bootcamp begins in February. Can't remember the date, but if you're interested, make sure to send me a message. Let's look at what we're going to talk about here. So today's a Q&A show, and these are the questions we're going to review. How do you calculate and apply? Hold on, let me get myself in there. How do you calculate and apply weighted average cost of capital? I'm going to show you a whole cool calculation that you can get. In fact, you can message me and I can send you this presentation. What terminal growth rate should I use in a valuation, and how to use sensitivity analysis in valuation, and why don't professionals use football field charts? Now, this is my question that I put in there because I see a lot of students and people in CFA Research Challenge talk about football field charts. And then number 5, one of my most annoying things that I ever hear is people say, oh, capitalism is only about maximizing profit. And I'm going to teach you that that's not true. So let's go into this 1 second. So the first one I want to talk about is about calculating weighted average cost of capital. And I'm going to take you through a series of steps. And before I do that, let me explain what I do. So I have been an analyst for more than 30 years. And over the last 20 years, I would say I've been collecting data and building databases and building data sets and looking at things on I like to look at things on an aggregate basis because that helps me to think about things. So together with my business partners, Sornsuck and Alex, we basically look at 26,000 companies worldwide that are listed in the stock market. And we buy that data, we download that data every day, every month, and we work with that data. And I like to do bottom-up analysis of that data. And from that 26,000, you can end up with about 10,000 companies that have good data, which kind of coincides with the largest mutual fund as far as the number of stocks held is the Vanguard VT fund that holds 10,000 stocks across the world. And that's where it's a good benchmark to understand, how many investable stocks are there in the stock market. Remember, there's almost 60,000 companies in stock markets across the world. But today I'm going to present some interesting data where I looked at 10,000 companies over 30 years. And from that, I was able to calculate an average balance sheet. And so I'm going to present that in a common size format. That means total assets are 100, and then each component of assets is some amount less than 100. And from that, I'm going to use that to explain the calculation of weighted average cost of capital. So before I do that, just shout out to those people that are responding and asking questions. Jeremiah Pornpen, Araiman, Deborah, Ajeni Fuja. I don't know how to pronounce some of these words, but I know some of you guys are from Nigeria. Aiki Okwu, Benjamin, Christiana, Sahat, Masego, and Dreeve. So congratulations. Thanks for participating and asking questions and asking for stuff. And I welcome everybody who's listening and viewing. Feel free to reach out. In fact, the presentation that I'm doing today, all you have to do is email me the words, the letters Q&A in the title or in the text, and I'll send you this presentation in PDF format. So let's get into the first question. How do you calculate and apply weighted average cost of capital? Well, the first thing we have to do is understand the capital structure. Now here, you can see that I'm looking at both liabilities and equity on one table. And at the bottom, liabilities and equity add up to 100, just as, total assets add up to 100. And in the current liabilities, there's 3 main types. overdrafts and short-term loans, which account for 7.6% of total funding or total assets, and accounts payable and other current liabilities. Normally these are separate, but for our purposes, I just brought them together and we can see it's 20.7. So that gives us current liabilities of the average company. You can see at the bottom, average number of companies is 9,745. So about 10,000 companies. And that adds up to current liabilities of 28.3. Then we have long-term debt, which accounts for about 20.5, other long-term liabilities, 11.8. That gives us long-term liabilities about 32. So on average, companies finance assets about 32% from long-term liabilities. And in fact, when you add the long-term and the short-term or current liabilities, you end up with 60.7. So that means that the typical company finances its business 60% from total liabilities and 40% basically from equity. Now, the problem is not all of these are, and by the way, let's look at the bottom of this. We can see paid up capital and retained earnings. Paid up capital is the original amount of capital that was put into the company, and up until right now, all capital that has been raised by companies, by these 10,000 companies, is represented as 16.5%. And retained earnings is all the profits that weren't paid out as dividend and were retained in the company. And that gives us the total equity of 39.3. Now, where it gets a little bit confusing is that when we look at weighted average cost of capital, we look at the interest-bearing liabilities. So overdrafts and short-term loans at 7.6, that's interest-bearing. Our accounts payable and other current liabilities, interest-bearing? No, definitely not. And long-term debt is interest-bearing. So we really can see that it's short-term and long-term debt that's the interest-bearing funding. All the rest of it is what we would call spontaneous liabilities that the company has as it exists, basically. It gets credit terms and the like. So now let's go to our next step. So in calculating weighted average cost of capital, now we need to understand the capital structure. So like I said, short-term debt at 7.6, long-term debt at 20.5. So if we add up debt, it comes up to 28.2. Now, of course, this is the book value of debt. But for our purposes, usually we want to use the market value of debt, but generally the market value of the debt and the book value of debt is not that different compared to equity, which you're going to see. So let's just accept that total debt at book value represents market value, and that's 28.2. What about the book value? Well, the book value of equity is 39, but we know we need to look at the market value of equity, and therefore what I did is I went and looked at my calculation of the current price to book multiple globally across the world. So this is 10,000 companies, and that price to book multiple is 3.5. So we can multiply that times the 39.3 and end up with an estimate of market value of equity. Now, when we're looking at a company that's listed in the stock market, we know the market value of equity. It's the price times the number of shares or market capitalization. But for the purposes of this exercise, I've done this calculation, which gets us to a total level of capital of 166.3. That's the interest-bearing liabilities, which is debt, plus the market value of equity. So now the next question is, what percent of market value of capital is debt versus equity? And you can see it's about 16.9 for debt and 83.1 for equity. Now let's just take a moment there and think about that. About 17% of funding is coming, right? So let's just go back and we'll look at that. About 16.9 is coming from debt, but 83 is coming from capital. Now, that's a little bit of a strange number because the 83 is the market value of equity. And the market, you could argue, is pretty inflated these days. So you have to have in mind the market value when you're calculating weighted average cost of capital, because if the price to book multiple is very high, as it is right now at 3.5, let's say the average price to book multiple is about 2, maybe 2.5, I haven't looked at the average in a long time, but I would say 2 to 2.5. So then the next question is, well, should we use, when we're calculating the weighted average cost of capital, should we use the current price to book multiple? Well, the answer to that's no, but I did it just to keep it simple. But the answer to that's no, because when we're trying to calculate the weighted average cost of capital, the question is, what are we doing with this weighted average cost of capital? Well, we're using it to discount future cash flows. And those future cash flows go to infinity, because the value of a company is all of the future cash flows that company can have, right? Until you sell it, you have a right to it. And so that's the reason why we don't want to use the current price to book multiple. We want to use a long-term price to book multiple. But for our purposes, I'm going to keep it simple and just use the current one, and that is the 3.5. So now we can see that we have a heavy amount of equity, and equity is always more expensive than debt. And so that's going to push up our weighted average cost of capital. So now let's go to the final step in the calculations of weighted average cost of capital. And that is when we're looking at the cost of capital calculation. So I've calculated the average cost of debt of these 10,000 companies, and it's about 3.5% to 4%. So I'm going to use 4% to keep it simple. I've calculated the average tax rate of these 10,000 companies, and it's 28%. So what we need to do is we need to reduce the 4% by 1 minus the tax rate. So 1 minus 0.28, and then we multiply that times 4, and that gets us to an after-tax cost of debt of 2.9. Now, it's important to do the adjustment to make the cost of debt after tax, because when we're looking at the free cash flows, they're after tax. And when we're looking at the dividends that are paid to investors, they're after tax. So we want to get everything on an after tax basis. So now we can then calculate 2.9 times the 16.9% that debt is of total market capital value of total capital. And that basically gets us to 0.5, because it's a very low number, 2.9 times a very low amount of debt in the structure. Now, for fun, I plugged in an estimated cost of capital at 10%. And then I said, okay, 83% is equity. Therefore, we can use 8.3 for the cost of equity component of capital. And we add up the 0.5 plus the 8.3, we end up at 8.8. So about 9%. So here we can see, now, why did I use 10%? Well, because the average annual return in the US market has been about 10%, depending on, you could say between 8 and 12%, but I'll just use 10%. That's been the average annual return in the US. And I think that's a good starting point, because if you're living in a country that you think this is a higher risk or lower risk country, then you can say, I think the long-term return is going to be higher risk than the US, and therefore I'm going to say an expected return of not 10%, but maybe 11 or 12 or something. You don't want to get too extreme on these numbers. You want to end up somewhere in between. Welcome, Deborah. Good to see you, and glad to see your messages coming in. Keep those questions coming from all of you guys. All right, let's go back into this. So now we've got our cost of capital, and it's about 9%. And that makes sense, because 10 is the cost of equity, and we have just a small amount of debt. So there is the answer to this first question. Remember, if you just email me the words Q&A, I'll send you this presentation so you can study it yourself. Okay, next question. What terminal growth rate should I use? Okay, this is a challenging one here. What I've done is I've looked at the average annual nominal GDP growth rate from the 50s all the way through to 2025 right now, so far through the 2020s. And the average has been about 6.5%. Okay, now let's talk about that for a moment. 6.5, is that nominal or real? Well, the important thing to think about in economics and economic numbers whenever someone talks about GDP growth, they're almost always talking about real GDP growth, meaning nominal growth minus inflation. But when we're analyzing companies and we're looking at growth rates of companies, are we using nominal or real data? We're using nominal data. If you look at the financial statements, it is this data as of this period of time. It's not adjusted for inflation. So whenever we're applying a GDP growth rate or the like to companies, we need to think to use nominal. So what was the nominal rate? The nominal rate was 6.5. Now, the next question that we have to think about is, are we going to have 6.5% growth rate forever? Well, first of all, we have to remember that this is only US data. I actually have another data set that I had that was global data, and it's going to be lower growth because global markets have had a lot of ups and downs. So let's just take a number like 6% or 5.5% for global growth. And that would start to give us some idea of what the terminal growth rate has been. I would say 5.5 to 6.5%, depending on whether you're looking globally, that's closer to 5.5. And if you're looking at the US, it's about 6.5. So now we have to ask the next question, what do we think the growth rate will be going forward? Well, if you're a real optimist like Elon Musk and you say that, we're going to hit a whole new level of productivity with AI and the like, then you could say, oh, I think that long-term growth is going to be higher than 6.5. It could be 7. It could be 7.5. And if you're a pessimist, you may say, oh, it's not going to be that. It's going to be 4.5. So the first question is, what do you think? And I fear that AI is just making people dumber, less smart, not using our brains as much anymore. It's hard for me to see that AI is going to cause some kind of boom in the economy. Also, remember that just as one company is using AI, another one's going to use it too. So it just raises the competitive stakes, but it may not change a whole lot. So in the case of what I teach and what I do in my own business and in my own Valuation Master Class bootcamp, what I say is, let's assume that the future nominal growth rate is going to be 5%. And if that's the growth rate for the overall economy, then you can't have a terminal growth rate larger than that, because it is an infinite series that would eventually exceed the size of the overall economy. And that wouldn't make sense, that any one company would be larger than all companies. So that's why I tell my students, keep your terminal growth rate between 0 and 5%. And be ready to defend it if you're at 5 or if you're at 0. Now, you could have a negative growth rate, but eventually the terminal period would, the terminal value would disappear. All right, let's continue on. So, next question. How to use sensitivity analysis and valuation? Well, sensitivity analysis allows us to change things and see what the outcomes are. So in the Valuation Masterclass Bootcamp, students use my value model, and I built this into the value model right here. The first question I ask is, what if sales growth changed by X from the base case? So the base case for the particular company that I'm looking at in the model here that I extracted this from, the base case is only a 3.5% growth rate in revenue. But I asked the question, well, what if it increased to 3.9 or 4.2? Or what if it decreased to 3.2 or 2.8? Now, I have an area on my spreadsheet that I can change those, but let's just stick with those for right now. And what we can see is that from a free cash flow perspective, the value doesn't change very much because these are pretty small changes for the company. Now, let's look at a more significant one. So first we looked at revenue growth. Next, we're going to look at gross margin change by what percentage points from the base case. So here we can see that my assumption for this company is 23.6 for gross margin, and it could go up to 28.6 or down to 18.6. And we can see that if it was to go up to 28.6, the free cash flow value would be 2.6, not 2.3. And if it was to go down to 18.6, then it would be 1.9, not 2.3. So these two measures are related to the fundamentals of the company. So I don't look at, what if operating margin or net margin. I just use gross margin. Pick your margin, but I use gross margin. It's easy enough for me. So we either have revenue growth or margin change. That's it. Those are the two things that I'm testing when I do sensitivity and my students test. But what about things that are related to discount rates and the like? Those aren't related to the fundamentals of the company. Now, let's go and look at that. I'm going to show you the next two tables. This was sales growth and gross margin change. The next two are, well, what if the discount rate changed, or what if the terminal growth rate, TGR, changed? So let's first look at the discount rate. Now, you'll notice there's no entries for EPS growth or net margin change or ROE, because these are not fundamental changes. They're only changes in our discount rate. So here we can see that the cost of equity in this particular case is 10. And if we lowered the beta to 0.8, that would bring the cost of equity to 8.6. And that would raise free cash flow value to 2.6 from 2.3. And if we were to say, okay, let's just say, I think I needed to fix my my flow there. But let's say that the beta goes up to 1.1, then we end up with a value actually falling, right? In that case, because the discount rate is rising. Now, the fourth one there, I got to change something on that later. So, okay, so now let's look at terminal growth rate. The base case for this particular company is 4%. And that gives us our value of 2.3. And now the only way we can go with terminal growth rate here is up 1. And that would get us to 2.6. And if we went down by 2 percentage points, so from 4 down to 2, we would be at 1.9. So how do we use this? Well, we can basically use it to try to show an investor and ourselves, what if things got better? What if things got worse? And here we can see, I'm going to go back one page. On a free cash flow basis, the worst case could be a 1.9. Our average is 2.3. That's what we're saying the value of the company is. Could go down to 1.9. Yep, that would be the lowest. And the highest would be 2.6. So 2.3 is the price, and there's a range between 1.9 and 2.6. So this gives you a little bit of idea of how to use sensitivity. In my model, I coded in the sensitivity in my model, and actually I didn't, Sontech did, and I work with him to do that. But in that coding, what you have to do is take out all your forecast data and put that in a temporary spot, let's say in an Excel sheet in your model. Then you need to plug in the new data based upon your assumptions that you're putting into that table. And then you need to extract from the new data being put in all the fundamental and valuation outputs, park that in a sheet, and then you need to take the old forecast data and replace that back into the model so that you're back at the place where you started. Otherwise, you're going to get your model all messed up. And so in order to run the sensitivity in my model, my students know you press the button, it calculates it by extracting the current forecast, parking it, going in and putting in the new forecast, getting the outcome of that, parking it, and then adding the previously parked forecast back in. But we do that all through coding, so you don't really pay attention to it. DP says, though it has a lot of potential, but this AI narrative feels a bit overhyped too. Yes, definitely. I mean, there's two aspects to it, right? One, the overhyped nature is just that they may not be able to make as much profit from it. I think Google will be the big winner because they can bundle it. Even Microsoft's having trouble really standing out, but in the end, they're going to be able to bundle it with their products and services. Whereas ChatGPT, I think you can't exist alone these days. All right, so let's continue on. The next question is, why don't professionals use football field charts? And I just want to explain to you, a football field chart is something like this. I went to the website of fe.training, where they have this football chart explaining what it is. And this is Financial Edge is the name of the website. Check them out. You can learn about the football chart at their website, which is cool. I love all finance websites because everybody's working to try to figure things out. But the reason why I mentioned this one is because in CFA Research Challenge, as a judge in the past, I've seen students present their football field charts, and it's almost meaningless to most professionals. And that's because we know that valuation is not calculated that way. It's not like, let's take an average. This one's high, this one's low. The truth is nobody really knows what's the way to value this company best. We think we know. We say, okay, this is going to be on PE. This is going to be on price. Banks are valued on price to book a lot of times. Property companies, PE, industrial companies or consumer staples, maybe discounted cash flow. High dividend payers, maybe dividend discount model. Lower ones could be free cash flow. And then after that, what we then come up with this long list, or their football field. And just because we have that list doesn't mean we're right. And we don't know what each of those valuations are. So we can say that if we don't know, we don't have great accuracy in valuation. It's nice to think that we do, but we don't. And the result of that is that the average of estimates doesn't mean that is right. And I think a lot of people look at averages and think that, well, if this stock, I value it at $50 by this method and $150 by this method, therefore value should be 100. No, there's no logic in that can support that. An average is just telling you a midpoint. So that's the reason why football fields, a seasoned professional doesn't see a lot of value in a football field type of chart. All right. So I did see Deborah said, can you walk through free cash flow to firm and free cash flow equity? Yeah, I'd love to do that. Why don't we do that next Friday? And I'll add that for it. And I'm going to walk through it because I have a great way of explaining it so you can see all the detail in even more detail. Last time I went to free cash flow, but I want to compare free cash flow to firm to free cash to equity. DP says, without it being built into the model, sensitivity analysis is going to take a lot of time and effort. Yeah, sensitivity analysis is something that is the benefit of using a professional model like the one I use. The second benefit of that is that I have error checking. And I would say I never would build those things into models when I was an analyst because there's no point. I'm not trying to scale up and cover 1,000 companies. I'm just going to cover 10 to 20 companies. So you could argue that there's not a lot of reason to do that. All right, last question. This question is kind of annoying to me because I hear a lot of young people say capitalism is about maximizing profit. I'm sure you probably heard that before. Well, that's nonsense. And anybody who repeats that doesn't know what they're talking about. And I'm going to explain to you why. And I'm going to do it through a simple formula, a formula that every finance student knows very well. This formula shows us that the value of a business is the sum of the discounted cash flows. The profit is in the numerator and the risk is in the denominator. And ultimately, business value comes from the future cash that's expected to generate, adjusted or reduced or discounted for risk. And that's what a discount model does. So managers maximize value by balancing higher cash flow with acceptable risk. And this diagram helps us to understand that it's not about maximizing profit. It's about maximizing profit and minimizing risk. So actually what it's about is maximizing value. So the next time somebody doesn't have knowledge of capitalism comes and says, you greedy capitalists, all you care about is maximizing profit, that's wrong. Or if somebody comes to you and they say, yeah, those guys are just trying to maximize profit. They're cheating. They're paying bribes to the government and stuff. Well, the fact is that by getting a higher cash flow, but doing it through, let's say, corruption that could eventually, be revealed, that could destroy the company. And so the end result of that is that We have to value. It's not enough just to say, I'm going to maximize profit. Let's just say that you say, okay, I'm going to cut everybody's salary. I'm going to cut all the marketing budget. I'm going to maximize profit. Fine, but you're going to increase the risk of the future cash flows of the company, and therefore you're going to destroy the value of the company. And your job is to maximize value. Wow, we covered a lot of stuff today. I want to thank you for joining. Now it's time for me to wrap it up. But for those people who want to join the Valuation Masterclass Bootcamp next time, just send me a message. You've got my emails. Hold on, let me just put my thing up front. Remember, you can email me at Andrew Stotz, and then I'll reply to you there, and I'll also send you this. But if you're interested in the Valuation Masterclass, make sure that you reach out and talk to me about it. That's the final episode for this week. That's the Q&A episode. Remember, if you want to build a competitive advantage in company valuation, join us in the Valuation Masterclass Bootcamp. Next one starts in February. My name is Andrew Stotz, and I hope you have